All right, you guys, let's start out with a chart of the S&P. We'll go from a daily chart to a weekly chart to a monthly chart to a yearly chart. So we're really going to focus on the S&P. We have no positions long or short in the metals right now or in treasuries, but we'll touch on those at the very end. Closed today at 1342, down just over 9 points, 9.31 points, well off the lows for the day. So actually a fairly decent day. Trend line is intact. This will be the 8th Friday YouTube video in a row that we have the overall trend as long in equities. Overbought, yes. Could it continue to go up? Absolutely. 1350 is our area of resistance. Above that would be the 2011 highs around 1365, 1370. We did close above 1350 yesterday, Thursday, at 1351, almost 1352. This trend line is intact. Where would we kind of sit up on our seat and take notice if we were to break 1320, if we were to break 1300, or the low, which was right just above 1300, the low that was put in on Monday, January 30th, we would be out. We would consider that to be a trend change. We would be breaking the trend line and also support at that time. So 1300 definitely out. 1320 sitting up on our seat. One of the things we did yesterday in the managed accounts just prior to the close is we went in maybe 50 minutes prior to the close based on this candle, which is kind of a smashed shooting star. But I've seen this before. If you look at the wick right there, that little line, normally that gets filled to the upside, which happened today, even though the S&P was off the lows of the day, which means that the SH, the inverse short the S&P, was off the highs. We do have a position in that right now just to hedge our long positions. We will be putting a stop in at 37.44. That will be a mental stop based on a close. We could be stopped out as early as Monday. Or if there's more selling in the S&P, this will move up, and then we'll just put a hard stop in at 37.44. We're thinking that we might fill this gap here. Doesn't necessarily have to happen on this run. We could, come down here, meaning go up on the S&P and then eventually fill that gap. But we believe that gap will be filled. We also think that sometime we're going to come up to this area here of 39.90. It may not happen on this trip, but we'll see. But in any event, for every 100 shares we had of the VTI in the managed accounts, yesterday towards the close, we bought 100 shares of the SH. And the reason for that was just to stop any potential bleeding, which there was some bleeding today, but not as bad as it was intraday. All right, so that's that. That's just a little hedge action. We'll see if it's worth doing. As of today, so far, it's worked out. Let's go back to the S&P on a daily. And let's move it now to a weekly chart. This is what we've started out with the last couple of weeks. Pretty much the same theme. We could be looking at a very bullish inverted head and shoulders or a cup and handle. And if you're with us for the first time, the most probable outcome at this time is if we were to see some selling around this 1350 before we take a run at the 2011 highs, and we build out a similar base here, a channel if you will, or a left shoulder, and we do that over here where maybe we're in a range between 1320, 1360, maybe 1310, 1350, in that range. We're only going to hit resistance so many times and we're going to break through it to the upside. If that happens, we're going to take out more than likely the 2011 highs. Now, when we look at this on a monthly chart of the S&P cash, again, you can see it a little more clear where if we kind of build this out without breaking down, without breaking the trend, the next stop above these highs would be right around 1400. 1400 was once resistance, then became support, broke through the support, became resistance, and then we had this kind of Lehman collapse here. So we'll see. Now, we are bullish. We think any pullbacks are going to be bought. However, if the trend changes based on those numbers, 1320, 1300, we would exit long positions and let the short position run. Let's look at this on a yearly basis now. Now this really pertains to buy and hold people, because when we look at this on a yearly basis, we had an all-time top basically in 2000, right? Over 1500, 15 and change. And then we basically cut that in half. And then we had the big move up, taking out, almost like a daily chart, taking out the top of 2000 just by a couple ticks. And that occurred in the fall of 2007. And then literally after that, the markets came apart and we had the Lehman collapse to boot. So we dropped another 50% give or take then. Now we've had this big run up. Certainly it could stop at any time. It could change direction. The trend could change. But quite possibly, I should say, is we could chop sideways here, and sometime in 2012, 2013, if this bull continues to run, we could challenge the highs that were put in 2000, 2007, and then also potentially 2012, 2013. The reason I bring this up is not only because we could be in a very bullish scenario, but also that if that occurs, there's going to be a lot of traders, a lot of individual investors that may not really know what they're doing, that think they're smart because the market's going up and they're in it. But we could see a triple top in the market sometime in 2012, 2013, again, assuming that we're going to run up and test these all-time highs. So we'd have a 1 top, a 2 top, maybe a 3 top somewhere in here or here, and then we could head south again. So I guess my point is it's important not only on a daily basis, a weekly basis, but an overall basis to look at the S&P in terms of trends, because even though we may go up to near all-time highs, that could be a major opportunity to get short when a trend change is confirmed. All right, you guys, so that's it for the S&P. Let's just touch on gold briefly, very similar to last week. On GLD last week, we ended up, let's see, Friday, Monday, Tuesday, Wednesday, Thursday, Friday. So we ended up right here. At that time, we said if you're not long GLD, let's wait till we get above 170 on a close. We never got above 170 this week on a close. If you're in it, I would have my stop around 160, 160, close to 162. We may not come down to 162. We could have a retest failure, maybe head down to 165, 164, start heading back up again, kind of a 1, 2, 3. If that's the case, again, we still don't want to get long till we're above 170 on a close. And then also, if you are long, have your stop just under 162. As far as bonds, could go either way. Right now, to me, there's a lot of overhead supply. On the 7 to 10 year IEF, exchange traded fund, again, I'd want to see a close above 106. We could come up and fill this gap. This was a potential false breakout here. If you're in it, or you're going to get in it, I would have my stop under 104.40. But for me, I would just wait till we got confirmation. And if you did get in above 106 on a close, still have that stop at 104.40. On the longer end, TLT has a lot of overhead supply. If you look at a March contract of the 30-year, basically the same picture. There's a lot to fight through here. I'm not saying that we're not going to get to new highs anytime soon, but there's just a lot of overhead supply to fight through. So for us, for our purposes right now, we have no position in treasuries, long or short. We have no position in metals, long or short. We are simply playing the stock market. And as of the close on Friday the 10th, the overall trend is long for the 8th Friday video and the 8th Saturday anti-Wall Street show in a row. We have a hedge in place in the managed accounts. We'll remove that hedge if the market rallies next week. All right, you guys, that's it. Thanks for listening to the show and the blog. We'll see you guys next week. Doug McKay, anti-Wall Street guy, on the record for the 10th of February, 2012.